We have an outstanding economic team carrying out this effort, led by Secretary of the Treasury Hank Paulson, Federal Reserve Chairman Ben Bernanke, SEC Chairman Chris Cox, and FDIC Chair Sheila Bair. I thank them and their dedicated teams for their service during this important moment in our country's history. This is an anxious time, but the American people can be confident in our economic future. We know what the problems are, we have the tools to fix them, and we're working swiftly to do so. Our economy is innovative, industrious, and resilient because the American people who make up our economy are innovative, industrious, and resilient.
12 seconds later.
CBS News Special Report, a presidential address to the nation.
Good evening. This is an extraordinary period for America's economy. Over the past few weeks, many Americans have felt anxiety about their finances and their future. I understand their worry and their frustration. We've seen triple-digit swings in the stock market. Major financial institutions have teetered on the edge of collapse, and some have failed. As uncertainty has grown, many banks have restricted lending. Credit markets have frozen, and families and businesses have found it harder to borrow money. We are in the midst of a serious financial crisis.
All right. Today is Wednesday, May 10th. And this is, I don't even know what this is. It's a talk. It's a discussion. And folks, I got a good one for you tonight. And apologies for the absence last night. I've been experiencing this pain in my neck. And apparently there's a swollen lump right by my throat. And of course, thank you to everybody who brought up throat cancer. That was classy. But I was thinking, how did I get throat cancer? Did I do something? Did I eat something? And then I read the headline. It says, oral sex is the leading factor in throat cancer epidemic in the United States. Doctor says. I'd like to see who that doctor is, but apparently it's an epidemic, ladies and gentlemen. Everybody got throat cancer now. And I know what you're going to say. Attaboy, Maverick, you got throat cancer, but you got it from eating pussy. You should be proud of yourself. Actually, if I have throat cancer, it wouldn't be from eating pussy. It would be from eating a bag of dicks in the stock market. I mean, today in the morning, I was watching the CPI, the inflation index, and what the market is going to do, and it comes out, according to the cooks at the Bureau, exactly meeting expectations. Little salt, little pepper, but that's about it. And immediately, I had a hunch that this is going to be a funny market today. It's going to be a battle between the robots and the monkeys. And what do you do in this kind of environment? You have to start thinking as a robot and as a monkey at the same time. So I put my robot hat on and I'm looking at the chart and I said, okay, if I'm the algos right now, you know, AI, for your information, AI has been with us for a long time and AI is dumb as f. Just look at the algos in the stock market. And I looked at the chart of the SPY, the S&P 500, and I shared this with you in the morning. And I said, okay, if I'm a robot, if I'm the algos, I gotta be looking at 413.56. And the algo is going to be fixated on one number alone, like a magnet. And then I put my monkey hat on, and I said, okay, if we trade above 413.56, buy. If we cross below, you sell. Easy does it. And here it is. 5 minutes chart of the S&P. We open above the number, and then there's a flush down, but the robots buy right away, and they push it all the way to 413.56, but they can't make it. They start to pull back. Okay, that's a sell signal right there. Boom. Then we go down all the way to the support of 410. That's a buy. You cover the short. And guess what? It goes a little below. And it crosses above again. And like a magnet, it goes all the way back to 413.56, and then you sell. Easy does it. When it comes to the Qs, we gave you this chart in the morning. The number the robots would be looking at is 323.63. This one did not work as anticipated. We open above. We go down in a retest to the same number and we bounce. That's a buy. And then we go down and we cross below. That's a sell. But it doesn't last for too long before it crosses above again, and that's a buy. And it goes and crosses below. That's a sell. But then the chart goes above the number again. Oh my God, I'm going to get caught in a squeeze here. Whoop, wait a minute. We're okay. We cross below again, and the expectations are okay. I'm going to buy, I'm going to cover once we get to 321.5, because that's support. But the chart bounces and rebounds before the support. And now all of a sudden we're back like a magnet to 323.63. And then, okay, I'm buying. And we close the day and you're happy, right? And then you wake up in the morning tomorrow and the chart is down again at 323.63. Weird action, to say the least. Bitcoin crashed midday and then recovered. The stock market was up and down, up and down, up and down. What's going on here? You know what? We'll talk about it and a lot more. We'll cover the CPI in tonight's video for the members channel, the market analysis. So join or die. And I know what you're going to say, but Maverick, you charge too much. $10, that's a no-go for me. Here's my rebuttal, and here's what really bothers me. How much are you paying for OnlyFans? $25 a pop for how many girls? And you've been stalking the same chick for 2 years now, jerking off to the same feet picture over and over and over and over again. What is that process anyways? What does that take? 30 seconds? A minute? Tops? I'm giving you an hour every single day. And most importantly, I care about you. I'll send you my feed picture for free. But you know what? The only OnlyFans account that is worth subscribing to is this one. Because this lady is smart. The headline reads, how a 45 years old OnlyFans star has earned over $1 million in revenue from charging more to see her face to using Reddit to promote her accounts. So she's kind of a maverick, right? No face. You want face reveal? $40, baby. And you know what really baffles me in this economy with all of this? They talk about inequality all the time. And this might sound sexist, but, you know, the entire channel is going down the toilet anyways. But if you happen to be a female person, let's say in your late 30s or 40s, if I happen to be your financial advisor, I would say, what the hell are you doing? How come you're not doing OnlyFans? You think this body's going to stay tight forever? You think gravity's not going to win at the end of the day? Well, think again. You better capitalize on this OnlyFans mania before it's done. Because once the recession hits, no more OnlyFans. And oh, by the way, when AI takes over, guess what I'm going to be doing? Forget about the stock market. I'm going to be an AI pimp. I'm going to create all of these AI females, ageless, perfect bodies. I'm going to send them all the way to OnlyFans to juice up some money from these bozos, and boom, that's passive income. Millions and millions of dollars. So ladies, you better start capitalizing on this OnlyFans mania before it's over. But I know what you're going to say. What about dignity? What about my reputation, Maverick? Who cares? Would you like to work selling insurance all the way till you're 65? And then what? You retire to enjoy the last 2 years of your life while you're suffering from throat cancer? Or would you like to retire now? And by the way, you don't even need face reveal. You can stay anonymous. And guys would jerk off to anything. A picture of a nose, an earring, a toe, it doesn't matter. But I know for the gents, if you happen to be 40 years old and you're single, you're going to say, Maverick, stop shaming us for having OnlyFans accounts. It's the only form of entertainment that I got as a 40 years old virgin. And my response is, relax. You're a baby. You're 40 years old. You're a kid. And now you're going to say, whoa. So women in the late 30s and 40s, the clock is ticking, but a guy in his 40s, that's a baby? What's up with the sexism, Maverick? You know what? I did not make the rules. You want to get mad at somebody, get mad at the big guy upstairs, because he made all the rules. And by the way, his views on gender, you probably don't want to dig too deep into that. But you're still praying to him, so what are you giving me a hard time for? The bottom line is, folks, if you're 40 years old male, relax. You got a lot of time. You can lose your virginity when you're 70. You can have kids when you're 79. You can run for president if you're 80. You look at Bob De Niro. He just became a father for the 7th time at 79.
What's wrong with... I want to and I want to
And since we're talking about age, we have to give the viewers updates about previous segments that we've done in this channel. We talked about the media purge with Tucker Carlson and Hadley Gamble. I've been saying, you know what? How the hell did Hadley Gamble rise out of nowhere all of a sudden with these important interviews? She got to interview Putin. She got to interview Crown Prince Jared Kushner. She became the senior reporter from the Middle East. What's going on here? Well, it turns out that Hadley Gamble got fired too. She accused her boss of sexual harassment, and now she's getting the pink slips. You know why? Because, yep, she was banging somebody important. Somebody with a lot of money. And that somebody is Tom Barrack. And he got her the interviews with Putin and Prince Jared and all of those people. And I was positive that Tom is married. I could even swear on it that he has a wife. so I'm not sure what's going on here. But a few years ago, Hadley Gamble did an interview with Tom Barrack, and things started to grow from that point on. Until, of course, she made an interview via Zoom, and Tom Barrack showed up in the background. And look at her. She's like, get the hell out of here. And she's trying to block him with her body. That's not working. And look at her. She's, get the hell out of here, asshole. And now we know why she was favored at CNBC. And of course, the biggest loser here is not even Hadley Gamble. The biggest loser here is Putin. Matter of fact, Putin put this up on Twitter today. I don't know if you saw it or not. Take a look. Hadley Gamble, you cheated on me. You broke my heart with another short, bald-headed guy. But now you don't have a job, so I must help. I will put you at #1 anchor at TV Russia. You get paid more than CNBC. But first, I must take care of business. I must take revenge. I will start new special military operation against this piece of shit Tom Barrack. And speaking of pimping himself out to sugar daddies, Tucker Carlson got a new job, and he pimped himself out to sugar daddy, the biggest one of them all, sugar daddy Elon Musk. He got a job at Twitter. And sugar daddy Musk now, he wants Don Lemon to have a job at Twitter. And of course, after Elon made the dumbest deal in history of overpaying for Twitter, he's out of cash right now. So he has to raise a lot of cash to pay for these anchors. Luckily for him, he got the cash cow we call Tesla stock. But he promised you culties that he's not going to dump anymore, right? But sugar daddy Elon got another trick up his sleeves. He would not sell shares and alienate you. He would ask his brother Fredo to dump shares, and then Fredo gives him the money, and he buys Tucker Carlson. So for all of you who continue to buy Tesla stock, you think it's going to go to the moon, sugar daddy Elon, thank you so much for playing. Please come back again. But folks, let's talk about something important here. This economy. Is it good? Is it bad? Is it going to crash? Is it going to go in a soft landing? What's going on with the economy, Maverick? All I know is when I hear everybody talks on TV, they say, oh, but this economy is resilient. The consumer is resilient. The stock market is resilient. Everything is resilient. Keep your blindfolds on. Everything will be okay. I'm like, when was the last time I heard that the economy was resilient? Oh, yeah. Back during the GFC 07 when President Bush at the time said that the U.S. economy is strong and resilient. And the economy kept crashing. And then he came out and said resilient again. Maybe that's going to do the magic.
The economic team reports that our economy has a solid foundation, but that there are areas of real concern. The economy is still creating jobs, though at a reduced pace. Consumer spending is still growing, but the housing market is declining. Business investment and exports are still rising, but the cost of imported oil has increased. My administration has been watching our economy carefully. My advisors and many outside experts expect that our economy will continue to grow over the coming year, but at a slower rate than we have enjoyed for the past few years. And there is a risk of a downturn.
Oh, man, there's always a catch.
We're in the midst of a challenging period, and I know that Americans are concerned about their economic future. But our economy has seen challenging times before, and it is resilient.
And of course, the economy kept crashing, and they kept pumping it with more and more cocaine, courtesy of the taxpayer, billions and billions of dollars. And that's, by the way, that's the Conservative Party, pumping billions and billions of dollars into Wall Street, into the resilient economy. And the signs were already out there. Most of us knew the economy is going to crash, the stock market is going to crash. You have to be blind not to see what's happening. All what you need to do is talk to old dinosaurs who've been trading the market since the South Sea Bubble, the likes of Art Cashin, for example. Listen to what he said back in 2008, before the crash. Take a look.
Some people say this doesn't stop until the housing hits bottom. You think that's true?
I think that's probably correct.
Veteran trader Art Cashin believes there could be more casualties.
This is the fifth time we've seen this movie. And you sit on the edge of your seat and you yell at whichever character it is, don't go into that woodshed. But they keep going in.
And they kept going in. It's Darwinism. Survival for the fittest. You want to have the Darwin Award? Go ahead, jump in, right into the slaughter machine. And it's happening again, folks. It's clear to everybody who's been watching the economy for a while what's about to happen. Deja vu all over again. And they keep going to the woodshed, piling billions and billions and billions of dollars into the stock market. In the month of April, over $10 billion of inflows into ETFs. But Maverick, a lot of folks say that this is the stock market bottom. We have a new bull market. The economy is okay. We're going to have a soft landing. Let's see what history says. You get a bottom, a legitimate start of a bull market rally after the crash, while the recession is ongoing. You don't get a stock market bottom and a bull rally before the recession. Actually, what we're seeing right now in the stock market is step number 3, right before perhaps the most epic crash we have witnessed this century so far. Step number 1, the yield curve steepens out of inversion. Step number 2, credit tightens in the economy. And the last step, the Fed cuts rates. And then the crash happens. So are we there yet is the question. Let's try to answer that using the facts and the data. And folks, here it is, in focus tonight. Is it happening again? Spoiler alert, yes it is. When we talk about the yield curve inversion, it has always been a reliable sign for an upcoming recession. And what do we have these days? A massive, the biggest yield curve inversion this century so far. When we look at the 10-year to the 3-month spread, look at this. The inversion is absolutely insane. You can see that in red. And every single time we got an inversion, the stock market crashed shortly after because it was indicative of an upcoming recession. Now, viewers who are not familiar with the yield curve, what are you talking about here? I'm confused. We're talking about the bond market. When you buy a bond for 10 years, should it not pay you more than a 3-month bond? We call them bills. The answer is absolutely yes. It should pay more because I'm holding a bond for 10 years versus a few months. But what if I told you right now, this moment, the 3 months bill and even the 1 month pays more than the 10-year bond? I'm not making this up at all. It is a sign of an economy that is about to head into a recession. People appreciate the moment right now, 1 month from now, 3 months from now, but they're not sure about the long run. They see the economy is in a recession, so there is no point in appreciating anything long term. Everything is in the short run right now. But perhaps the most used and the most reliable yield curve inversion is between the 2-year and the 10s. Every single time, literally, every single time the 2 and 10s inverted, it was a warning sign for an upcoming recession. Right now, we have the worst inversion since the 1980s between the 2 and 10s, but that is the warning sign. The question becomes, when do we start shedding our pants, Maverick? The answer is when the yield curve starts to steepen out of inversion, which a lot of folks mistaken as, oh, the economy is getting better. I guess the economy doesn't see a recession anymore. This has been always a mark for the beginning of the recession and the beginning of the crash. What do we have right now? The 2s and 10s are steepening again out of inversion. They're not positive again, but they're going to get there at some point. And this steepening is the warning sign that time is running out. The economy is going to crash into a recession, and with it, the stock market will crash too. And this has been always the case. The yield curve steepens into a recession, and this is happening right now, meaning we're just maybe a few weeks, a few months away from the recession beginning. With that comes the crash. But that's condition number 1 for the crash. The curve steepens. So can we have a check mark on this one? I would argue yes. What about step number 2? We see credit tightening. And the question is, are we seeing this happening right now? The answer is, let's look at some indicators. For example, if we look at the annual commercial bank credit growth, number 1, it is below trend. Number 2, it is in a negative trend. It's not showing us negative ratings yet, but that is not a requirement for a recession. All what we need to see is a negative trend. And we're seeing that happening right now. But is this indicator enough? The answer is not even close. We have to look for more indicators. How about this one? Community Bank Sentiment Index. We have negative sentiment among community banks. But again, it has been negative for a long time. So can we rely on that we're seeing credit tightening in the economy? Maybe not. What about the Credit Cycle Index? What does that say? It is diving down. It is crashing all the way into negative territory, which is again a good indicator that the economy is heading into a recession. But is it enough? It is certainly stronger than Community Bank Sentiment Index, but it's not enough. Let's dig more. The headline from Reuters says the credit crunch the Fed fears may already be taking shape. What are they talking about? And mind you, this is from last month. We'll give you the update in a minute, but the Fed's last SLOOS, SLOOS, in February showed that the net percentage of banks reporting tightening standards for commercial and industrial loans in the fourth quarter jumped above 40%. Listen to this. That is consistent with levels reached before or during the last four recessions, 1990 to 91, 2001, 2007 to 09, and early 2020. Similarly, demand for these loans also slumped to previous recession levels. And mind you, folks, all of these readings before banks even started to blow up. Here's another one. The NFIB's last survey, this is for small businesses, meanwhile showed that credit conditions for small firms measured by the loan availability compared to 3 months ago index deteriorated sharply to the worst in over a decade. Wow. This index, 4-point increase to 9 from February, a higher print means credit is harder to access, was the biggest month-on-month rise in over 20 years. It will closely be watched on Tuesday. A separate NFIB banking survey published this week shows small business owners are not hitting the panic button yet, but concern is growing. And here's the update, folks, the SLOOS that we got this week. Again, a higher rating means tighter lending conditions. Folks, whether we're talking about credit card loans, whether we're talking about commercial real estate loans, small firms, any kind of loans you're looking at, we are now heading into readings we have not seen since the crash of 2020 and the Great Recession in the early 2000s. So without a doubt, we're seeing massive credit tightening in the economy, and loan officers are saying that the crackdown has begun. And again, a reminder, a higher rating means tighter conditions. We're now heading back to the highs of the crash of 2020, the great financial crisis, and the recession in the early 2000s. Isn't this a reliable indicator that the economy is heading into a recession? We are certainly seeing massive and rapid tightening of credit conditions. But if that was not enough, what about the demand for credit? A lower rating means no demand, crashing demand. Higher rating means higher demand. What are we seeing right now? Demand is crashing in certain categories. In commercial real estate, this is the lowest reading in history. Small firms crashing, credit card loans weakening, auto loans weakening, all in negative territory, by the way. So the demand is going down and credit tightening is indeed happening in the economy. And if that was not enough, what about mortgage credit availability, which fell to the lowest level in a decade, ladies and gentlemen? Is this enough for you? Do you get the picture now that we have tightening credit conditions in the economy? Maybe not. Let me read this one for you. It comes from Bloomberg. U.S. credit conditions to weaken to post-pandemic low, banks say. U.S. credit conditions for consumers and businesses are expected to deteriorate in the next 6 months to their lowest level since the pandemic, according to a survey of chief economists at 15 of the nation's biggest banks. The American Bankers Association said on Thursday that its credit conditions index fell to 5.8 in the second quarter from 12.5 in the first quarter. A reading below 50 in the gauge, which is derived from answers to the survey, indicates that the economists forecast weaker credit conditions in the coming 6 months. The economists expect banks to tighten credit standards this year in reaction to still elevated inflation and higher interest rates, leading to weaker growth in consumer spending and business investment. All 15 economists see credit becoming less available for businesses over the next 6 months. And listen to this, while almost all anticipate the same happening for consumers, the association said. ABA's latest credit conditions index recognized the recent strong credit quality will be challenged by heightened uncertainty and broader economic headwinds this year. And this is according to the ABA chief economist. He also added that lenders are responding with cautious and prudent underwriting. And if that was not enough, when we look at earnings calls for this season, the mentions of credit tightening, quote unquote, has skyrocketed to the highest level, higher than the GFC. What more do you need? What more evidence do you need to see that this economy is heading into massive credit tightening? What are the implications on the economy? We talk about the consumer being the core and the heart of the economy. Well, you just heard the bankers, and they say that they're going to tighten consumer lending standards. Almost all of them agree that this will be the case. What are the ramifications of that action? We'll look at consumer savings. That has already crashed. And with inflation sticky and staying high, the consumer is running out of savings. What is the last resort? The answer is, how about going into debt? We see consumer debt, household debt skyrocketing. Be it mortgages, auto loans, credit cards, student loans. The consumer is now using more debt than ever. And the consumer has been accustomed, that's the key word, accustomed, during the QE era, the easy money era, of living based on debt. They got their jobs in the bag. They can live beyond their means using debt. They can travel, they can buy goods, services, and stimulate the economy using debt. And that was okay until inflation showed up. Once inflation shows up, higher rates comes with that. And with higher rates, no more living beyond your means. Your job is not in the bag anymore. And oh, by the way, inflation remains high, but tightening credit conditions means that the accessibility to loans and debt will be harder. What does that mean in English, Maverick? It means that the consumer will have less to stimulate the economy with, and that's recessionary. Credit card debt is now at all-time highs. U.S. consumers owe about $1.2 trillion in credit card debt, and rates continue to rise higher. They're getting squeezed, and they can't have access to more credit because those rates will go higher. The lending standards will become tighter. After all of this evidence that I showed to you, do we have a check mark on credit tightening? The answer is absolutely yes. There is a debate whether the bigger banks might ease credit conditions and lending standards, but why would they? Why would they be the dummies? I say credit tightening is happening all around us right now. And now it comes down to step number 3, the first Fed cut. Once that happens, the stock market will crash and we will head into a severe recession. So be careful what you wish for. The stock market is rallying higher based on expectations that the Fed will cut rates. But is it really that good? We showed you in this channel in previous videos that every single time the Fed cut rates, they did so for the wrong reasons. And mainly that is either, number 1, something blowing up in the economy, a systemic risk, or number 2, the unemployment rate surging higher. So again, be careful what you wish for. So let's go back to Reuters. It says if U.S. rates futures are the barometer, however, financial markets could not disagree more. Secured overnight financing rates, the SOFR futures on Thursday, priced in as much as 100 basis points of easing by year end. Easing means cutting. And the Fed funds futures indicated the first cut could be as early as July, and that would be a quick pivot to rate cuts from hikes, but not unusual. In fact, it would be in line with historical trends, according to Joe Lavorgna at SMBC Nikko Securities. The median pivot over the last 18 tightening cycles going back to the 1950s is 2 months, and the average is 3. So if you're saying that this was the last hike that we got last week, then we got 2 to 3 months before the Fed starts cutting rates, and they will do so for the wrong reason. See, the Fed for now says we're going to pause and hold. There is no cutting. You guys are out of your minds. The market says, no. You're going to cut right away. That was the last rate hike, and you're going to start cutting rates immediately. And I say again, be careful what you wish for. You better hope that the Fed is right, that the Fed will not cut rates, that they're going to pause and hold instead. Because if they do pause and hold, it means the economy is still intact. If they cut prematurely, as the market is pricing in right now, it will be for the wrong reasons, ladies and gentlemen. And we're talking 1,000,000%. You see, before SVB collapsed, we were talking about a Fed rate of 6% because inflation is getting out of hand. We were talking about in July, we will be at 6% Fed funds rate. Now, all of a sudden, we're talking about cutting. And we're talking about cutting from 6% for the wrong reasons. Because banks are collapsing. The actual cut will not happen until something bigger blows up or the unemployment rate surges significantly higher. And ladies and gentlemen, let's not play any games here. Every single time the central bank raised rates out of the blue aggressively, we have seen something breaking. From the subprime mortgage crisis to the tech bubble, to the stock market crash in '87, when the Fed raises rates this aggressively in a short amount of time to catch up with inflation, something is going to break. And we know that regional banks are breaking right now, but soon enough it could be brokers, companies that you know, companies that you use every single day, could blow up. Major banks, bigger than regional banks, could blow up next. Commercial real estate, residential real estate, zombie companies. That's when the Fed starts cutting rates prematurely. No pause and hold. They're going to cut rates immediately. 100 basis points right off the gate for the wrong reasons. We go back to the same report that I showed you from 2008 when they interviewed Art Cashin. Listen to what the reporter says right after that in the same segment. Take a look.
The Federal Reserve meets tomorrow. The expectation before the events of this past weekend was that the Fed would sit tight on interest rates. But now some are actually forecasting another Fed rate cut tomorrow. Katie?
And boom, that was the moment. They cut rates in September. October, the market was crashing. Lehman blew up. And again, folks, condition number 3 is Fed rate cuts. They're gonna happen, but they're gonna happen for the wrong reasons, regardless of what imbecile Jerome Powell says. He says we're gonna have a soft landing. No. You're gonna see Jerome Powell in a few months coming out and saying, emergency meeting, folks. The Federal Reserve is gonna cut 100 basis points to accommodate the collapsing economy. Oh, excuse me, did I say that? His own economists are ringing the recession alarm, warning that stocks and real estate prices could tumble. The Fed's own staff is sounding the alarm, saying, Mr. Powell, it's time to wake up. This is not going to end in a soft landing. This is going to end in a massive crash. But the chairman of the Fed, who told us that inflation is going to be transitory, now tells us, rest assured, we're going to have a soft landing in the economy, contradicting his own Fed. The New York Fed published this chart right here that we just showed you in the beginning of the video. The inversion of the yield curve between the 10-year and the 3-month bill. Every single time, as you can see in the chart, every single time we got an inversion between the 10-year and the 3 months, we got a recession. And even the New York Fed now says there is a 68% probability of a recession coming, higher than what they predicted back in the GFC in the early 2000s. And we go back where we started. Do we have steepening of the yield curve out of inversion? Check mark. Do we have credit tightening in the economy? Check mark. Do we have the first Fed cut? The answer is not yet. So what are we waiting for? The answer is tick-tock. In the next few days, in the next few weeks, something bigger will blow up. And it's going to shock the world. And then the Fed will cut rates. And that will be the beginning of the crash, the beginning of the recession. The sky is clear now. But as Jamie Dimon says, the storm clouds are coming. And it's not a joke anymore. If the CPI report today proved anything, is the fact that inflation is sticky and rates will stay higher for longer until something breaks. And they will break something really soon. You can dismiss this message as doom and gloom. That's up to you. I've heard the same thing back in 07, 08, and then we all know how that ended. And all what we're seeing right now is just deja vu. The same old story. We have seen the movie a million times before, but we never learn. And the reason is, human psychology never changes. And with that, folks, we have reached the conclusion of this video. And just so you won't be alarmed, all what I got is inflammation in my vocal cords. The doctors would say you gotta take a break from yelling at the microphone. I would respond by saying, ain't nobody got time for that. And by the way, I got another video coming this evening, the market analysis, so stick around for that. But folks, I hope that you enjoyed this video, you found it informative and entertaining. And if you did, please subscribe, press the like button, the notification bell, you know the deal. Folks, this is all I got for you for tonight. Thank you for listening. Thank you for watching. And I will talk to you again tomorrow. Good night.
Ignore me again at your cost.